Now let's start to talk about our state of the market. And I had spent hours to prepare these slides today. And I wanted to show you guys here, I keep stacking it on. You guys probably have seen this before, but as you see, we are doing really well. New listings, we have continued to adding more new listings. And then for September, for the month of September, you see that we also have more closed sales compared to 2019. And this is numbers from all 5 counties in the Bay Area. Now, if we look at this chart is for Santa Clara County from June 2019 to October 2020 with all the residential properties. As you see that if the green represent the median number of days on the market, and you see that last year it stayed on the market much longer, almost double the number of days for this year. And if you look at how people are offering, how competitive the market is, last year was not as competitive as this year. And this year we definitely have more competition, more multiple offers. And the following slides, we're going to explain to you why this has been happening. And one thing I thought extremely interesting is that if you look at this part, how it had jumped up where January 2020 and then February 2020 and also March 2020, the offer price, the offer price over the sold price has jumped up so much. So people are really, even before COVID, they have already started buying and they have come out very aggressively. So we're going to take a look at it, why this is happening. All right. So here is another chart where we're going to look at number of sales and number of new listings. And sorry, let me go back. And we see that we have definitely a lot more, more new listings. And also we have very strong number of sales in the Santa Clara County. And this chart is showing us all the median sales price versus the number of active listings. So the green line here is showing that it's starting from 2003. So the median sales price has been going up. We have gone through some, downturn over here, 2009. But then as you see that after we pretty much around 2013, we have already come back to the previous peak. And since then it has gone above and beyond. And then the active number of listings though, as you see, is actually has gone down. Our supply is really, truly in historic low right now. And that is the reason why we have so many people who need to buy, but we don't have enough listings to sell. So that's why the market has been pushing the prices up, because it's simple, supply and demand. And when you have very low supply, your price is going to go up. And here is a chart comparing last month and this month's number, where you see the single family residence for Santa Clara County, and this is provided by Santa Clara County Association Realtors. We have more closed sales compared to last month, and compared to last year, we have 36% more compared to last year. And this side is talking about the condos, and we have also 36% more closed sales for condos as well. And then the median sales price is 1.4. We're hitting $1.4 million for single family, and also $800,000 for condos. The price also had gone the price had gone up for the single family, but you'll see that the condos actually have come down. And this really, we've been explaining to a lot of our clients, is that because of this shelter in place, people spend so much time inside the house, and you really now figure that you really do need a much bigger space, and also your own space. You want less common areas. So that's why we noticed a huge shift of our buyers looking for single family compared to condos these days. Now, San Mateo County here, you'll see that actually the price has gone down from since August. Median sales price was 1.81, but this month it had gone down to 1.77. But then they still have very strong sales, like they have a lot of closed sales, 430 compared to 388 for single family residents. While the condos, the price had come down as well. The days on the market is slightly higher, but then they still have more condos that had been sold compared to last month. And Bay East, this one is a little bit, is really big area. This is provided by Bay East Association of Realtors, has numerous areas. So I'm not gonna go over every single cities here, but as you can see that compared to 2019, you see all green numbers. These are all green percentage positive increase on sales price. So you see that they are all going up quite a bit since last year. And same thing all the way from the more inland and also north, the North Bay area, most of the sales price had gone up as well, besides Moraga. This is the only one that has come down a little bit, slightly. Now, what about the economic market updates? What's going to happen? So many clients, so many buyers, and even sellers, they are asking us, like, what do you think about the market? You know, do you think that the market is going to come down? I heard rumor that it's going to crash because of election, because of forbearance. So I want to answer some of these questions through these slides. So one of the most interesting thing is that since the beginning, everybody, all these economists, and you hear a lot on YouTube videos, they've been trying to predict what kind of recovery shape we're going to be in. Are we going to be in a V shape, W shape, U shape, L shape? And now politicians are talking about K shape. And as you see here from Fannie Mae, and Fannie Mae was actually awarded as the most accurate forecaster, and they had said that this is more of a V-shaped recovery. Now, just a couple days ago, the chief economist for IMF had just had an interview on CNBC, and this is what she said. Our baseline assumption is based on no further stimulus. We have done the calculation. If there is a stimulus, which is about the size of the CARES Act, we will add about 2 percentage points to growth in 2021, which means instead of US coming back to 2019 level in 2022, it will actually return much faster in 2021 back to the 2019 level. So whatever, if we are going to get the stimulus package, is a really big factor to consider in terms of how our economy is going to recover. And what about the election? Is the election going to affect housing? So from Myers Research, Ali Wolf, she's the chief economist, and this is what she said. History suggests that, however, that the slowdown is largely concentrated in the month of November. In fact, the year after a presidential election is the best of the 4-year cycle. This suggests that demand for new housing is not lost because of election uncertainty. Rather, it gets pushed out to the following year as long as the economy stays on track. And she had actually talked about, in this article, talked about that they had gathered all the past 50 years of data to come up with this conclusion. So, and I also suggest to our clients, because the election year, we see that ourselves too. Almost every time if there's an election coming up, the market has slowed down a little bit, and then but right after election is over, no matter who wins, they come back to look. It doesn't mean that they're not looking anymore. It's just that a lot of buyers or sellers, they're just not comfortable with that uncertainties, and that's why they're pushing out that decision to buy or sell later. And now what about forbearance? As we see here on this chart, the forbearance actually is decreasing right now. And we do know that some of the property owners are applying for forbearance based on, you know, they said, like, well, it is offered to me, then I'm going to take it just in case something happens, if the economy is not coming back or I'm not making any income anymore. But we do see that the forbearance, number of active forbearance is actually decreasing. But I know people are still really worried because of the unemployment. And as you see here, number of months of unemployment greater than or equal to 9%. In these recessions, Great Depression lasted about 108 months. Our last recession, Great Recession, lasted about 30 months. And the 1980s oil recession lasted about 19 months. And 2020 recession for unemployment rate lasted about 4 months, that when the unemployment rate is 9% or more. So a lot of people were saying, well, you know, we still think that a lot of people are going to file for foreclosures. And I had started my career in 2005. So I definitely have gone through the Great Recession at the time because of the mortgage crisis. At the time, actually, a lot of our buyers, they were buying with no money down, 5% down. And we even had loan program that offers 105% of the market value. So you're not putting any down payment, you're actually getting money in order to purchase at that time. But look at this chart. This is talking about like the percentage of homeowner equity in 2020. So more than 87% of the homeowners have more than 20% of equity. And more than 92% of homeowners have more than 10% equity. And 42.1% of homeowners actually do not have a mortgage. That means they have 100% equity in the property. So what does this mean? It's like the previous recession is due to people just giving up their property, they're going into foreclosure. But this time, even though they have filed for forbearance, one is that the banks they will not be, they don't want to take back the properties. Secondly, that a lot of homeowners, because they do have equity in their property, they can just put it back on the market to sell it. So we don't think that this is going to cause a lot of foreclosures, and we do believe that because the housing market is healthy enough that a lot of homeowners will be able to either keep their property or refinance into a lower interest rate. And especially in the Bay Area, we have our market's a little bit unique and is a little bit different. And so that's why we really do not think that we're going to have a high foreclosure rate. Now here, of course, that's just me talking. So I want to see what other organizations are projecting on the home prices. So we have Fannie Mae, National Association of Realtors, Mortgage Banking Association, et cetera. They have made their projection. I'm putting these two charts together because there's one that is from last projection, where there's another one that is for more updated projections. As you see that from Mortgage Banking Association, they used to project about 4% increase on home prices. They did come down on their projections to 3.4. But Zelman, they're projecting 3%, and they just adjusted their projection to 5.9. They're very optimistic about the economy and the housing market. And another one is CoreLogic. CoreLogic went from negative 1% to actually positive 0.6% increase on the home prices projection. So that is definitely a very positive outlook. And as we are talking about mortgage market statistics now, and if you look at mortgage rates currently, for 30 years fixed rate, jumbo rate, it has come down to 2.875. And 2.875, this is as of today, October 14th, and it has come down. I remember when we first started, we were talking about 3.25, and then now it has come down to 2.875. And here is the mortgage rate projection, same thing, like Freddie Mac had come down on their projection. They expect the rate is gonna come down to 3.0, and so all the way through 2021 2Q. So now here's the question, the demand for home buying, because of the interest rate has come down, the demand for home buying is going to continue to go up, and then the price will go up. Now, why is it that because of the interest rate comes down and there will be more demand? Because your monthly mortgage payments actually increases by around 3% for every 0.25% increase on your interest rate. So maybe we can take a look at this chart instead. Look at 1Q of 2019. It was at 4.4%. And then 2Q of 2020, it had come down to 3.4%. That was 100 basis point lower in 2020 2Q. And what that means is that your monthly payment actually can make about 9 to 15% difference, depends on your loan balance. So with a $1 million loan balance, that's almost $600 difference in your monthly payment. This is the reason why so many people came out to look for properties, because you can't get this kind of rate in the future. This is our historic low. I've never seen rate like this. I personally just refinanced as well for my house, and now our monthly mortgage payment is so much lower than before. So I truly highly recommend that don't wait on this home buying, because I think the prices are going to continue to go up at least for the next year or so. Now, multifamily, I'm going to go over this really quickly, but I thought I want to share this with you guys. Federal Reserve for September 2020, their bulletin, they have shown that U.S. household, they have an average net worth of about $749,000. But then if you are actually a homeowner, you have a median net worth of $246,000. $246,000, while if you're a renter, it's $5,300. And then 2019 is the same. It's like 255 versus $6,000 on median net worth. You see, this is like almost 4 times, sorry, not 4 times, it's like 40 times more compared to a renter. So I highly recommend anybody to consider to be a homeowner if you can, obviously if you can afford it. And this is the multifamily activities in Peninsula and San Francisco. The thing that I like to look at is their cap rate. The cap rate is remaining still very strong at right below 4% for both San Francisco and Peninsula. And East Bay, we are a little bit higher, is about slightly above 5% now. And then for Sacramento, actually, we're about 5% as well, actually slightly lower than 5%. And Stockton has been a market that a lot of our clients have been very interested in. As you see, we actually started having our clients to invest in Stockton since 2016. And you can see the per unit price has come up from $60,000 to over $100,000 to about $130,000 per unit. And their cap rate is still at about 6% currently. I know some people think that Bay Area, you just can't have multifamily that has more than 5% cap rate, but Stockton is just about an hour drive from Oakland. And here, let's come down to Silicon Valley. We have a market occupancy of 95.3%. And especially today, we're going to talk a lot about San Jose. So as you see that San Jose, we still have pretty strong occupancy rate. The rent is still pretty high, although the rent has come down slightly. The East San Jose part actually has gone up, but then other part has come down on their rent. And the cap rate is still right above 4% right now. And then the price had come down a bit. And this information has been provided by Colliers. This is their fall 2020 market report. So it's been really helpful. If you guys need a link to check out their market report, feel free to let me know and can share the link with you guys. So lastly, I want to share this because I thought this would be a great segue to introduce Nathan and talk about San Jose. Hi, Nathan. So I want to talk about this. We have, as we know, the RENA goal, especially they had just adjusted the goals for Bay Area region to 60% of affordable housing out of the whole 485 units. So I'm just wondering, this is one of my questions, is that what is City of San Jose is going to do regarding providing affordable housing? So, but in the meantime, let me just stop sharing here and introduce everybody again, introduce Nathan to everybody again so you guys can listen to him. I know he has a lot of information to share. Thank you so much for watching our YouTube channel. And don't forget to subscribe to our channel, like our videos, make some comments because we're going to keep you posted on the most updated real estate news, housing market data, and also real estate tips and advice from all over the real estate industry. So thank you so much for watching, and I'll see you next time.